Today I'm excited to have Brock Vandenberg of Calamar Financial with us today on our educational webinar on investing in trust deeds with your IRA or 401k. Brock, do you want to say hi?
Absolutely, Brian. Thank you for having me back on. I know we've done a couple of these webinars successfully, and I look forward to this educational webinar on investing in trust deeds and hearing more about self-directed IRAs.
Well, great. Well, just so everybody knows the format, I'm going to get started here. I'll speak for about 15 to 18 minutes about self-directed IRAs. Then we'll turn it over to Brock, who's going to have a great presentation, I'm assuming. I've seen him before, about our self-directed IRAs. If anybody has any questions, either hit the question button, and we'll get to those either at the end or during the webinar, or you can write in the chat box on the bottom of the panel there. So we'll go ahead and get going now. Little disclaimer before I get going. AccuPlan doesn't endorse or provide investment advice. We're not broker-dealers or financial advisors. All the information here is for educational purposes only. So getting that out of the way for the lawyers. A little bit about myself. Brian Davis, for those of you who don't know me, Director of Business Development for AccuPlan in San Diego. I've been in the self-directed IRA space for over 5 years now. I've been in real estate since 2002. You could even say before that, if you include my family's background, which my parents are rice farmers and have been avid real estate investors my whole life. I went to college at UC Santa Barbara, graduated in 2001, moved down to San Diego in 2002, and I was a loan officer through 2007. Well, doing subprime loans in a builder division wasn't all that great in 2007 when the market climate changed for real estate, and that kind of put me out looking to do something else. I got into life insurance and annuities for a while, and then fell upon this self-directed IRA business, which has been very exciting, learning about how you can use your retirement funds to invest in different things like real estate. And I've been with AccuPlan for the last 2.5 years. We're one of the premier providers of administration services for self-directed IRAs and solo 401ks. We have our own trust company out of Las Vegas, Nevada called American Estate and Trust. And that allows us to be an IRA custodian so we can hold these investments in your IRA. So for those of you that don't know much about self-directed IRAs, you're not alone. I'll get to the history of it. In 1974, Congress passed the ERISA Act, which outlined the retirement system we see today with IRAs. It basically said you had to have an IRA custodian to hold an investment in your IRA. Well, those custodians have traditionally been the investment banks and insurance companies, which hold stocks, bonds, mutual funds, annuities in cases of the insurance companies, publicly traded assets, so what they're called securities. But that left open a wide space of different types of investments that those types of companies don't hold, which is where we come in. So like I said, we're a trust company, so that allows us to be an IRA custodian. So in 2010, there was just under $5 trillion in IRA funds out there. That number right now is somewhere around 6.5, the last figure I saw. And in 2010, less than 2% of that was in a self-directed IRA vehicle, so a vehicle that would hold alternative assets. That number is climbing now. That number is now around 3.5% from the last numbers I was told. So you can see our industry and our niche of the industry is growing. And a lot of that is because when the stock market crashed in 2008 and 2009, people were looking for different ways to handle those retirement funds because the retirement funds took a big hit. And for those people that know a lot about real estate or about investing in private companies or precious metals, now realize that they had an outlet to use those retirement dollars for. And a lot of it came around too, and when Mitt Romney was running for president a couple years back, that he had a self-directed IRA worth somewhere around $100 million. And as Brock here liked to coin, that's a way to Romnetize your IRA.
Blows me away that someone can have that much capital in their self-directed IRA, knowing that they're limited to $5,500 a year deposit, married at what, 11,000.
Yeah, well, my understanding is he was able to roll over some funds from his, employer qualified plan that he was the owner of, and move those funds over, and they did some very nice investing in it.
I need his CPA.
What we're seeing at AccuPlan are these main assets. We're seeing real estate, notes, investment in private companies, and even precious metals. Now, I don't see the precious metals so much, but that's something we hold as well in some different areas of the country. They do a lot of precious metals for some reason. I mostly see real estate, notes, and investment in private companies. There's just about 1 million things you can invest in with your IRA. As this list shows here, you can invest in rental properties, tax liens, raw land, oil and gas. This list could go on and on and on. These are just some examples of things you could do in your IRA. Going back to when Congress passed that ERISA Act, it didn't list the things you can invest in, only what you cannot invest in. And they really only listed 2 things: life insurance contracts and what the IRS deems as a collectible. And this is a list of some of those collectibles: a work of art, rug collection, stamps or coins, alcoholic beverages, anything illegal. And they even made some exceptions to this early on, allowing certain types of precious metals coins to be allowed in the IRA as well. But it's not that simple. Besides these investments that you're not allowed to be invested in, there's things called prohibited transactions. So this is where the big hiccups come in with the IRA. And prohibited transactions, and hopefully this doesn't get too jargon on you guys, are when your IRA gets involved with a transaction with what's called a disqualified person. And if you want to look up the rules on this, it's in one tax code, Internal Revenue Code 4975. But the essence is there's no self-dealing in your IRA. You can't have any personal benefit from your IRA's investments, nor can any of these disqualified persons, which you're a disqualified person because you are the owner of your IRA. Besides yourself, you want to think of it in a straight line up and down. So your spouse, your parents, your grandparents, your kids and their spouses, grandkids and their spouses are all disqualified from your IRA. So you can't buy a piece of real estate, rent it out to your college-age kids, and have them live in it, even if they're paying market value rent. That would be a prohibited transaction, and the penalties for prohibited transactions are large. You don't want to mess with the IRS, as this nice graphic shows here. But if the IRS is to see you got involved with a prohibited transaction in your IRA, they will go back and disqualify your IRA as of January 1st of the year that that transaction took place. So let's say I bought a property in 2010, and I rented it out to my parents. The IRS could come back, look at 2010, say, if you were involved in a prohibited transaction in 2010, we're disqualifying your IRA as of January 1st, 2010. So those funds just became pre-tax to taxable in 2010. So I'm going to owe money on my taxes for 2010 and whatever penalties accrue between 2010 and when they catch it. So you really want to make sure you understand the rules. And to kind of go through this a little better, I'll try to highlight this a little bit. We'll play the game Deal or No Deal, if everybody remembers this game from NBC a few years back. So could your IRA lend yourself $10,000? Is that a prohibited transaction or not? Is that a deal or no deal? That is no deal. That's self-dealing right on its face. You can't loan yourself money from an IRA. 401k plans, it's a little different, and I'll cover that in a second. What about your brother? Could your IRA lend your brother $10,000? Deal or no deal? This one is deal. Your brother does not follow in that straight line up and down. He's kind of on the side there. Now, I do want to point out, just because he's not a disqualified person doesn't necessarily mean that the transaction is prohibited. If you're using your brother to, you loan your brother $10,000 of your IRA, and he just ends up investing in your company or your investment, the IRS will say, you know what, that will fall into the indirect rule, and indirectly you're just trying to work around the rules, and the IRS will come in and hammer you if you try to just skirt around the rules. What about your stepson? Can your IRA lend your stepson $10,000, deal or no deal? This one is deal. If it was your son, it would be a no. But stepson, according to these guidelines, they're not a disqualified person. What about your daughter-in-law? $10,000. This one is no deal. Your children and their spouses. So it can get kind of complex, and if you have questions on it, that's where you want to come to me and ask me questions like, hey, Brian, I'm getting into this deal. What do you think? And I'll either be able to tell you pretty much or at least guide you and your financial advisors of where to look to make that definite conclusion. Well, let's talk about the funner parts of the self-directed IRA. How do I put money into a self-directed IRA? Well, self-directed is really a marketing term that we use, and it just highlights the fact that we allow people to invest in anything they want and everything allowable under IRS guidelines. So putting money into an IRA with us would be the same as if you had an IRA with any brokerage house or insurance company. So let's say you had a traditional IRA. We would open up a traditional IRA and would do what's called a trustee-to-trustee transfer to move the cash from that IRA custodian over to us to allow you the freedom to invest in these types of investments. And as this slide shows, there's no tax implications or penalties for that. The other part of it is people have a lot of money, not in an IRA, but in a qualified retirement plan, something like a 401k or a pension plan. Now, if it's with your old company, it's an old plan, you'll want to contact the plan administrator and do a direct rollover to an IRA with us. If you're still working at the company and you're still in the plan, I get this question a lot, can I move those funds over to an IRA? And the answer to that is maybe. It depends if the plan allows what's called an in-service rollover. Again, an in-service rollover. And you'll need to ask your plan administrator if your plan allows that. Some plans do, some plans don't, and there's some in between there as well. Some will allow you to do a portion. Some will only do it if you're 59 and a half or older. So you want to ask your plan administrator if you can take those plans out of your company's retirement plan and move them to an IRA. And then last but not least, you can make an annual contribution to your plan. For 2014, which we're highlighting here because it's still 2014, most people fall into the category if they're a normal W-2 employee, besides their company's retirement plan, is having a traditional or Roth IRA. You're allowed to contribute up to $5,500 a year to that plan. If you're over the age of 50, it's $6,500 a year. You can throw in an extra $1,000. This plan, a traditional IRA, is a pre-tax plan, and you make that contribution, you're able to write that off your taxes, and those funds grow tax deferred, so you don't pay any taxes until you take a distribution at retirement. With a Roth IRA contribution, there is no write-off when you put those funds into the retirement plan, but they grow tax-free. When you pull those monies out at retirement, you're not going to have to pay any taxes on those dollars. Then we'll get into some of these company plan IRAs. One of them is a simple IRA, which is very similar to a 401k. It's for small businesses. And from there, clients can contribute up to defer up to $12,000 a year to the plan. The company can make a small match. I don't see that plan as often as I do the next plan, the SEP plan, which is a self-employed pension. That's for the self-employed individual and their employees. This allows the self-employed individual to contribute up to 25% of their adjusted gross income with a cap at $52,000. The SEP and simple IRAs are also pre-tax IRAs, just like a traditional IRA. So those ones are pre-tax and they grow tax deferred. The other plan I've highlighted here is the individual K, which you'll hear called a solo K, solo 401k, one participant 401k. It's the same thing. It's a 401k plan for a self-employed individual who doesn't have any full-time W-2 employees. With this plan, you can make contributions as both the employee and employer. So it's a lot easier to make that maximum contribution as a SEP IRA, but it's a lot easier to make that contribution since you're being able to put in money as employee and employer. And we'll get into some of the highlights of this plan. We call our plan here at AccuPlan the 1K. And the plan itself is a self-trusteed and self-administered plan. What that means is you're essentially the custodian of your own 401k plan. So we have an approved plan document. You can buy that plan, adopt it to your company. If you're a sole proprietor, you can just adopt it to yourself. And you can go and make direct investments with the plan. Or some people do create a holding company like a trust or an LLC to then do the investment. But most of my clients that are doing this are investing directly from their 401k plan to the investment. This is checkbook control. It's a one-stop shop, and there's some other benefits here as well. You can roll over any of your other pre-tax retirement dollars into this plan. So if you have old traditional IRAs or SEP IRAs, that can all be rolled up in this plan, and then you can look at making some contributions to the plan. The plan also has what's called a Roth component, which means you can put some after-tax dollars in the plan like a Roth IRA, and that's in the employee deferral part. If anybody has specific questions about the solo K, if you're a sole proprietor, have your own company with no W-2 employees besides yourself or your spouse, let me know, and I can get into more specifics about this. So people really like the checkbook IRA pieces because you can go and make direct investments from there, purchase real estate, start a business, and go into that piece. And you can even loan yourself money, which is different than an IRA, as a plan participant. And you can loan yourself up to $50,000 or 50% of the plan asset, whichever is less. And again, I can go into specifics with people that have any questions on that. Again, feel free to use the chat box or the question bar and write in your questions, and we'll get to those a little bit later on. So one part of that checkbook piece of the 401k that people like, well, how can I do that in an IRA? I don't exactly fit the box of the sole proprietor, one-person employee company. So a lot of people use what's called a checkbook IRA. A checkbook IRA is when you create an entity that your IRA becomes the owner with, so a private company. So your IRA puts all the dollars and owns that company, and then you make yourself manager or trustee of that company to then be able to do the investments yourself. Traditionally, that's been through an LLC, where the IRA becomes the member of the LLC, and the IRA owner becomes the unpaid manager. So there's no self-dealing rules being broken there. The issue here in California, having an LLC costs $800 a year. Plus, if you're doing a lot of business, a gross receipts tax could come into play if there's over $250,000 in gross receipts. So a business trust can be used as another entity in place of that. Now, a business trust is taxed like a partnership, just like an LLC on a federal level. So if there's just one member, it's considered a pass-through entity. So there's no federal return that has to be filed for it, just like the LLC. But on the state level, because it doesn't file with the franchise tax board, it doesn't have to pay the franchise tax board fees, that $800 a year or gross receipts tax. If anybody wants any more information on this, check out my website, as it's listed here, retirementcheckbook.com, or contact me and I can get you more specifics about these checkbook IRAs, which are really great if you need to make investments very quickly or have a lot of payments that need to be made, and you don't want to go through the custodian every time. But most people just invest directly through us as custodian. So they open their account online, which just happens in a matter of minutes, and then they work on funding their account with either a trust transfer, rollover, or contribution, as we discussed. And then they direct us through our bi-direction letter to fund that investment. We usually take about 2 to 3 days to handle those things. We now have the ability to have online direction of investment forms, so people can upload their documents and tell us what they're investing in and do this all online. So it's a really great process. Again, as I mentioned earlier, you're not limited to those stock bonds, mutual funds. These real estate types of investments and private companies are open to you. You just need one of these self-directed vehicles to do it. So here's my information. Brian Davis at accuplan.net is my email address, or you can look me up online at accuplansandiego.com or retirementcheckbook.com. And from there, again, please feel free to put stuff in the chat box or question box, and I'm going to turn it over to Brock, and we can hear more about the trust deed side of things. Brock, you there?
Absolutely, Brian. Thank you very much for the presentation. Every time I listen to the presentation, I learn something more. Brian Davis and I go back, gosh, it's almost been 5 years now.
I think it has been over 5 years now.
Yeah. You had actually created my first self-directed IRA account along with my wife's, and then also did my solo 401k for the company. So
Yeah.
I have worked with Brian both on a business side but also on a personal level, and he's done a great job for us. So I recommend Brian Davis and AccuPlan to all of my clients. So thank you, Brian.
Yeah, thank you.
And also thank you for inviting me to speak alongside you on investing in trust deeds and using your self-directed IRA to do so. Today I'm going to tell you a little about investing in trust deeds. The purpose of what we're going to talk about today is give you the basic information that you need to know about getting started in investing in trust deeds. To give you some background, I started investing in trust deeds about 8 years ago. I come from the finance industry, and I was looking for an investment that was both in real estate and that also offered cash flow, and trust deeds really met that requirement. So as I invested more and more of my capital into trust deeds, I found the opportunity to allow others to invest alongside me. So what we do here at Talamar Financial is both invest our personal capital in trust deeds, but also provide a platform for others to invest in the trust deeds that we originate. So today I'm going to briefly go over what exactly a trust deed investment is. We'll go into the basics of how to structure a trust deed, how to maximize the yield that you're going to obtain over the duration of that trust deed, and then also how to minimize the risk to your capital. We'll talk about how to service that loan, get those payments from the borrower, and then what happens when it comes to payoff. We'll also talk about kind of the primary elements of what a trust deed consists of. So from a promissory note to a deed of trust, title insurance, property insurance, all the items that you need to understand and obtain when you invest in trust deeds. We'll talk about who's involved. How do you locate trust deeds? How do you service or how do you obtain those payments? Who's doing that for you? And then when it comes to payoff, how does that happen? And then we'll talk about the advantages of investing in trust deeds. We'll talk about cash flow. We'll talk about owning a percentage interest in a trust deed. So let me start off by giving you a little background on myself. As I had mentioned, I've been in real estate finance for almost 15 years. I got my feet wet as a financial analyst with KeyBank here in San Diego. And what we did was originate what's called joint venture equity and mezzanine debt. So we would partner with mid-sized residential developers throughout all of California and be their equity partner. We use the word in fix and flip business as kind of your gap funder. So we kind of had created a platform to partner with developers. We would invest capital on behalf of large pension plans, private equity and hedge funds, would invest in the funds that we created, and then we would manage those projects on behalf of those investors. I did that for a little over 4 years, and then had the opportunity to accept what's called a term appointment with the FDIC. What I essentially did was work with the FDIC to assist them in the actual closure of failed financial institutions nationwide. So I would be sent out with what's called a strike team. We'd go into a failed bank on a Friday, and then ensure that they had a secure closing, and then reopen that bank under a new name on Monday. And then we would take essentially their debt assets or their portfolio of loans and sell those off to the open market. And I had a great opportunity to work with the FDIC and some very knowledgeable and smart people over that period of time for about 3 years. At that time, that is when I started really getting heavy on investing in trust deeds. And also I had a growing family, so travel was limited for me. And so I had the opportunity to start Talamar Financial. Talamar Financial essentially focused on providing capital to individuals who were buying fix and flips, specifically here in San Diego, but really all throughout California. At first, I had enough capital to fund all the transactions or lending opportunities that we had, but then quickly ran out of capital and went out to the open market looking for other investors to invest in the loans that we originate. And that's how we created the platform where we are today. So we go out and we originate trust deed investments, mostly here in San Diego, but again throughout California as well. We invest in them, and then we also allow other trust deed investors to invest alongside us in those trust deeds. We post those on our website, so if you were to go to talomarfinancial.com, go under the Investor tab, you can see all the available trust deeds that we currently have available. Now, I got introduced to Brian through a networking event, and found quickly that a lot of the investors that I was working with actually had self-directed IRA funds to invest in these trust deeds, and I was completely unaware that this industry was out there. Now, today, I have about 40 to 45% of the capital that invest in the trust deeds that we originate come from self-directed IRA investors, and many of those are clients of Brian Davis. So Brian, thank you very much for introducing me to this marketplace. So over the last 3 years, we've funded well over $35 million in trust deed investments. We service an active loan portfolio of over $9.5 million. So that means that we have what I call funds on the street or active in various loans, nearly $10 million. We manage about 115 trust deed investors' accounts, which means that we have about a little over 115 investors in the various trustees that we have of that $9.5 million. And we typically originate about $1.5 million plus or minus a couple $100,000 of new loans each month. As we originate new loans, like I said, we post those on our website, and trust deed investors can go onto the website and look at the loans that we originate or the trust deeds that we originate and pick and choose the trust deeds that they want to invest in. One thing to differentiate ourselves with other trust deed companies is that we allow our investors to invest directly on the trust deed versus a fund, what we call a mortgage fund. The advantage to the investor there is that number one, they can select the trust deed that they want to invest in. Number two, they're not at risk of a portfolio that might be failing. They can directly work on the trust deed that they're invested in. And so that's one of the advantages of working with or investing in directly in a deed of trust versus in a mortgage fund. So let me go over the advantages of trust deeds. I always like to talk about the advantages of trust deeds, so you can think of that as I talk to you about what a trust deed investment is. And then we'll go back over those advantages of investing in trust deeds at the end of this webinar and talk specifically how you can get involved. So the number one thing that I see as the advantage of investing in trust deeds is that it's a fixed monthly income. Similar to owning rental property, just not having to manage rental property. You own debt, and that borrower is paying you a monthly payment based on the interest rate of that note. Now, most notes that we originate yield between 9 to 11% annually. So you get that over the duration of the year, paid in monthly installments, as long as that loan is outstanding. So for me, that's a great investment. Second, your investment is secured by real estate. That real estate is collateral. So as we're going to talk about, a trust deed investment is simply an investment that is secured on a real estate collateral, typically at 50 to 65% of that real estate value. The importance of that is that if that borrower stops making payments, you can always fall back on that real estate asset, sell that asset, and recoup your principal investment and any interest that might be due to you. The next advantage is that they offer very attractive returns. Typically, trust deeds yield between 8 to 12% based on the type of risk that you're taking. On the lower end, 8%, if you're secured on, let's say, a residential income property in a very strong market at a low loan to value. When I say loan to value, your loan amount compared to the actual value of the real estate. If you're around 50% of value, you're typically get on the lower end, closer to 8 to 9%. If you want to take a little more risk, maybe your higher loan to value, maybe your 65 or 70% loan to value, or the type of asset that you're investing in. Typically, residential properties are the most liquid asset or asset that can be sold the quickest versus some of the least liquid assets, which is land. You can imagine land is difficult to sell, especially in a market that is slow. So typically, you'll get higher yields for taking that risk. Additionally, trust deeds offer low to moderate risk. You can imagine if you're if your investment or trust deed is secured on a property at 50% of its current value in a very strong market, that's a lower risk investment. Obviously, if you're secured in a higher loan to value or on an asset that is less liquid, you're taking a little more risk. But typically, trust deed investments, if done right, you're looking for investments at 50 to 65% of the value of that real estate asset. This is one of the advantages that a lot of people don't talk about investing in trust deeds. Here in San Diego, it's very difficult to get invested in real estate just because of the pricing of real estate here in San Diego. You can imagine if you go to Los Angeles, it's even higher, and even in the Bay Area, it's even higher. So your barrier to entry is much higher. In trust deeds, you can invest in trust deeds at a minimum of $50,000. So the barrier to entry is much lower. And also, how that kind of rolls into investing locally is that you can invest $50,000 on a local level versus having to go out of state where the market barrier entries are much lower, but you're not there locally to investigate that investment. So this also rolls into the ability to fractionalize. So trust deeds, typically the average trust deed size that we are originating is roughly about $275,000. So you can imagine for a lot of investors that total loan amount is probably outside of their capability to invest in. But we do allow investors to invest on what's called a fractional level. So they can invest $50,000 in that $275,000 loan. So now it becomes more feasible for that investor to get involved in that trust deed investment. And lastly, the ability to use self-directed IRAs. So I had mentioned about 40 to 45% of my investor base uses their self-directed IRAs to invest in trust deeds. They get the tax advantages of using their self-directed IRA. So let's talk about basically what a trust deed investment is. A trust deed investment is simply you acting as the bank and lending money to a borrower and then using their real estate asset as collateral. So in this case, you have you as the trust deed investor are connected with your borrower and you're lending them, let's say, $50,000. Now, you're not just going to lend them $50,000, you're going to want collateral for that $50,000 investment. So that borrower is going to use their property as collateral for your investment. Let's say they have a home, an income property that's worth $100,000, and they use that as their collateral. Assuming there's no other trust deeds on that property or other liens, your loan to value, your loan amount of $50,000 secured on a $100,000 property is at 50% loan to value. That's a pretty safe investment. So you record your trust deed, you sign a promissory note with your borrower, and that borrower starts making monthly payments to you over the duration of that loan. So let's say in this case you agree and the borrower agrees to pay 10% on that money over the duration of that loan. Each month that borrower will pay you the calculated amount of 10% annually to you each month using that property as collateral. Now if that borrower stops making their monthly payments, you can foreclose on that property, sell that property, and get your principal investment back of $50,000 plus any outstanding interest that's due to you, plus any fees that were due to you as a result of the foreclosure. One misconception is that as a trustee investor that you foreclose on the property and you automatically get that property. So your $50,000 investment has now become a $100,000 or a $50,000 gain because that value of that asset is $100,000. Well, that's not necessarily the case. In foreclosure, only the proceeds that you are due at the foreclosure are actually paid to you. So your $50,000 plus lost interest plus fees, all the remaining proceeds go back to the borrower. But that's the basic structure of a trust deed investment. All right, let's go ahead and get to the next slide. If I can, there we go. All right, so I'm going to go into a little more detail about the structure of a trust deed. So as I had mentioned, you have, you the investor or the bank, are lending money to a borrower. In return, that borrower signs a promissory note. That promissory note details the loan. So it'll detail the loan amount, the payment structure that you've agreed upon with the borrower, the maturity date, who the borrower is. They'll go ahead and sign that note, and in that note they specifically state that they owe you you the trustee investor, a specific amount of money paid on a monthly basis, and then any other details that are relevant in regards to that promissory note. The next step is then to record that deed of trust on that property. And when I say record, you're going to record that against the title of that property. If that borrower chooses to sell that property or maybe use it for another loan, when the title officer pulls the title report on that property, they're going to see that there is an existing lien already, or your lien, your trust deed, recorded on that property. Now, this is where we talk about being recorded in first, second, third, fourth position. When you're investing in trust deeds, especially if you're new to investing in trust deeds, stick with what we call first trust deeds. That means you are in first position on that real estate asset. When that asset is sold, all the proceeds from the sale go first to the first trust deed lender. When that first trust deed lender is completely paid off, the remaining proceeds go to the second. When the second is completely paid off, the remaining proceeds go to the third. Now you can imagine how important it is to be in a first position on a lien on a property. You can imagine if there aren't enough proceeds from the sale of a property to cover maybe the full payoff of the second, and especially the full payoff of a third, you're going to lose money. So as an investor, and if you're new to investing in trust deeds, stick to what we call a 50 to 65% loan-to-value ratio on a real estate asset and in first position. Now, there are more sophisticated trust deed investors who are more than willing to take more risk to be in second position to get paid a little more on their investment. But again, if that borrower stops making payments, it gets a little more complicated in the foreclosure process, and then also adds a little more risk if there isn't enough proceeds for you, your entire trust deed to be paid off. So let's talk about the primary elements. Number one, we have the promissory note. Again, the promissory note is simply the document that specifically states that that borrower owes you, the trust deed investor, money. In our case, we had a $50,000, or the scenario that we had used earlier, we have a promissory note for $50,000. That promissory note is going to lay out the terms of that loan. So when the payment is due, who the payment is due to, when the maturity date of that loan is, and various other specific information as regards to that loan. You then have a deed of trust. That deed of trust is the document that is recorded against the property that you're using as collateral. It's important that that deed of trust is recorded because that borrower is using that real estate, or you're using that real estate as collateral. If that borrower stops making payment, you can go ahead and foreclose on that property, and being a lien holder or a trust deed investor with a lien on that property, you can sell that property and get your proceeds back that are due to you. Again, it's important to be in first position, and we can go into detail later about how you can ensure that you're in first position, but be sure that you're in first position because the proceeds from the sale of that property go first to pay off the first trust deed, and then the second trust deed, and then so forth. Now, there's a document called an assignment. So typically here at Telemar Financial, we fund 100% of all the trust deed investments that we originate. We then make those trust deed investments available to other investors. We go ahead and when an investor accepts the investment and wants to move forward with the investment, we assign our ownership in that deed of trust to the investor. Now the value to that by assigning that deed of trust to the investor is that that's the investor's interest in that loan. If Telemar Financial were to disappear, it really wouldn't matter because that investor has an assignment directly in that deed of trust. When it comes time to pay off that deed of trust or that borrower goes to sell that property, the escrow and title officer will reach out to the investor or the person that was assigned that deed of trust to obtain a payoff demand and then return their money to them plus any outstanding interest. So someone who has an assignment is secured directly on that deed of trust. And that again is recorded on that property. You have title insurance. So a lender title policy is crucial when investing in trust deeds. Title insurance insures you as a trust deed investor against a number of issues, mainly fraud. So if a borrower comes to you and is looking for a loan and you use their real estate asset as collateral, but it ends up they actually don't own that real estate asset, your lender policy will actually cover you for that fraud. In addition, let's say you're using a real estate asset in our scenario that's valued at $100,000, but there was an existing unrecorded lien on the property for some reason, a judgment of some type that borrower had, and that place your may have been recorded prior to your deed of trust being recorded. So where your $50,000 investment on a $100,000 property at 50% loan to value, which is what you thought you were investing in, they may have had a judgment against them for $50,000. So now your $50,000 investment is behind a judgment, and now you're not at 50% loan to value, but you're at 100% loan to value. That borrower stops making payments, you're required to foreclose on the property, and let's say the property sale nets $75,000. Well, there's the first $50,000 judgment is fully paid off, and there's only $25,000 remaining to pay off your $50,000 loan. Well, you would have a claim against the lender title insurance company against the $25,000 loss, which they'll go ahead and repay you. Now, there's a number of other reasons why you want title insurance, but those are the two primary reasons. And then property insurance, extremely important. You're using the borrower's real estate asset as collateral. If that real estate asset burns down, you've lost your collateral. That's why property insurance is imperative. On that policy, when you obtain that property insurance policy from the borrower, make sure that the policy is updated with you as a mortgagee. Their insurance broker, their insurance company will know exactly what you're talking about. You request that they include you as a mortgagee on that property. So if that property burns down, the proceeds would actually get paid to you first to recoup your loan on that property. And so the borrower simply couldn't just walk away with the insurance proceeds. And then lastly, an appraisal or BPO / inspection report. Now here at Telemar Financial, we typically do our own in-house property valuations. Because we have to act so quickly, we go to the property, evaluate the property's current condition, compare that against current sales in the marketplace, and come to a fair value on the property. But as a new trust deed investor, I highly suggest that you reach out to a local appraiser. obtain their services to get a true value on the property. Typically, the borrower will make the payment for that appraisal to be done. And then you can use that appraisal to adjust your loan amount to get to that 50 to 65% loan to value. In addition, I recommend an inspection report on the property. Obviously, you're using that real estate asset as collateral, and you want to make sure that that property is in good condition, or you at least understand the condition that property is in, so you can get a better value for that asset. So we talked earlier about the ability to fractionalize a trust deed. One of the advantages of investing in trust deeds is that you may not necessarily need the entire loan amount or invest in the entire loan amount. As I had mentioned, the average loan that we fund is roughly $275,000. There's fewer and fewer trust deed investors that can cover that entire loan. So we offer our trust deeds on a fractionalized basis, typically a minimum of $50,000. So let's say in our case we have a trust deed that we were talking about at 50. Let's just use a larger number, $300,000. Well, I have 3 investors that all want to invest in the trust deed. However, none of them have the full $300,000 to invest. Well, I offer them the opportunity to invest in this $300,000 trust deed if all of them just simply put in $100,000. Well, they all have $100,000, so they all invest in that trust deed together. Now, they make the interest payment, or they make the interest on that trust deed equal to their investment amount. So let's say that trust deed is paying 10%. Well, the investor 1, who's invested $100,000 in that deal, or 33%, will earn 10% on his $100,000. And so will investor number 2, and then investor number 3. Now, in this case, all 3 investors will sign a servicing agreement. The servicing agreement will specifically state their rights as a fractionalized owner in a trust deed. Now, it's very common practice to make the majority interest holder in a fractionalized trust deed essentially the majority say in that trust deed. If that trust deed goes into foreclosure, the majority interest holder has the final say as to what the execution strategy is. Some investors don't mind giving up that power to another investor if they don't have a full interest or the majority interest in that trust deed. Others prefer to have that majority interest. So that's something to take into consideration. And again, if anyone has any questions, please feel free to use that chat button or use the chat function to ask any questions. Some of this stuff gets pretty complicated, and I've done this for so long, I kind of forget what gets complicated and what's pretty basic. Okay, what's next? So you've agreed upon and invested in a trust deed. You've closed on the trust deed. That borrower has obtained their money from you for the loan, and you have recorded your deed of trust in first position on the property, and you have your signed promissory note. Well, now it's time to start collecting payments. Here at Telomar Financial, we actually use a third-party servicing agent. If you have a mortgage with a bank, typically you may make payments to someone other than your bank. They're what we call the servicing agent. Their responsibility is to obtain the payments from the borrower, process that payment, and then distribute it to the investor or investors on that trust deed. In addition, they send out the monthly statements to the borrower and the investor, and then the year-end statements as well. You can imagine it gets pretty complicated when you start talking about monthly statements to both parties, obtaining those payments. And typically a lot of my investors just don't want to interact directly with the borrower to obtain those payments. So they hire a third-party servicing company. One of the companies that we work with locally is FCI Lender Services out of Anaheim Hills. They're one of the larger hard money lender servicing companies. The advantage of them is that they offer that service, obtaining the payments, distributing it to our investors. But then you can also access your loan portfolio on their website. You just simply go to their website, log in, and you can see all the loans that you're currently invested in, what loans are current, when the payments are due, when distributions occurred. It's a very good service, and it's relatively cheap. And so we use a third-party servicing company to obtain those payments. When it comes to payoff, the borrower contacts you and says, Talamar Financial, we're ready to pay off this loan. I go ahead and contact my servicing agent. That servicing agent then submits what we call a payoff demand, or a demand for payment on that trust deed investment to the escrow officer handling the sale of the property. That escrow officer at payoff, or at sale, will then send the proceeds to the servicer, who will then in turn process the payoff and then send it or distribute it to the investor or investors on that loan. Now in our case, when that payoff occurs, those proceeds are deposited directly into the investor's account. That investor then has the option to look at the other trustees that we currently have available to invest in the next trust deed investment. So let's talk about some of the tips that I offer about investing in trust deeds. The first tip that I offer, stick with first trust deeds unless you're a relatively sophisticated trust deed investor. First trust deeds really put you in the power position. If you're ever forced to foreclose on a property, the first proceeds from the sale of the property go to you to pay off your trust deed. Also, if you're in a second position on a trust deed and the borrower stops making payments on both the first and the second, you as a second trust deed investor may be required to start making payments on the first to keep it current while you go through the foreclosure process. So unless you have those funds available to yourself sitting in an account to make that first trust deed what we call current, I would highly suggest just sticking with first trust deeds. On loan to value, stay below 65% loan to value. The reason why I like the 65% loan to value ratio is it gives you enough room if the market slows and let's say the property value drops by 10%. There's still enough cushion for you to foreclose on the property, get the proceeds from the sale of that foreclosure to pay off your loan, so the principal, any interest that was not paid over the course of that loan, and all your attorney fees as well. So I really focus on trying to keep below that 65% loan to value. One of the bigger concerns or mistakes trust deed investors have are they don't understand the collateral that they're using for their trust deed investment. We typically stick with residential real estate. The reason being is residential real estate is the most liquid asset. I know that I could sell a single family home here in San Diego probably within 30 days if priced right. Where it starts to get complicated is when you start to invest in commercial real estate, where you can imagine there's a lot fewer buyers looking to buy commercial real estate. And so you would have to take a significant discount on probably the value of that real estate to sell it within 30 days. And then you can imagine land, which is probably the most difficult real estate asset to sell in a down market. Nobody wants to own land. An old colleague of mine once said, you can buy a lifetime of land in a day, but spend your entire lifetime trying to sell that land. So stick with collateral that you understand. And more importantly, try to stick with collateral that's more on a local level. I like to look at every asset that we're using as collateral. I'll go visit, take a look at, and make sure it's something that I feel comfortable with. Verify the exit strategy and the timing of the trustees. So when a borrower comes to you and requests for a for a loan, and you're using their real estate as collateral, ask them, how are you going to repay this loan, and when do you think you're going to repay the loan? Now, we invest in a lot of what we call fix and flips. So the borrower strategy is to purchase a property under value, update it, doing an interior and exterior renovation, and selling that asset. I like that investment. And the reason being is, number one, they're buying an asset under market typically. Number two, their purpose is to update that asset. So they're going to make that asset better than what, at the end of the term of that loan, better than what we had invested in originally. And so if I were to invest, let's compare that to investing in an income property. Well, assuming that investor doesn't do any updates to it, you have an asset that is deteriorating in itself. The roof is getting older, the plumbing, electrical are getting older, and so that value, the value of that asset, the actual house itself, maybe not the land, but that value of that asset is depreciating. In In a fix and flip situation, that borrower's exit strategy is to update that property. So if I were to foreclose on that property and assuming he's finished the renovation on that project, I would have an updated house to sell in order to get recoup my principal and investment. In addition, I want to understand timing. Does that borrower expect the loan to be outstanding in 6 months? Okay. Well, how are you going to pay me off in 6 months? Is it supposed to be 12 months? Okay. Well, how are you going to pay me off in that 12-month period? When that 12-month rolls around and that borrower is unable to pay you off, go back and say, you have the capability of understanding why that borrower isn't going to be able to pay you off in that period of time. Borrower qualifications. So again, as a hard money lender, we typically invest in fix and flips. I want to make sure that that borrower has the experience and capability to successfully execute the renovation on that property. I, as a trustee investor, do not want to take ownership of the property, nor do I want to have to step in and finish that project on behalf of the borrower. So just as if you were hiring somebody with a resume, get a good feeling and get a good idea of what that experience is of that borrower. Utilize experienced trustee brokers. Now, here at Talamar Financial, we have originated this trustee investments for over 8 years, and so we have a pretty good pulse on who the borrowers are, what the borrower qualifications are, what the market is looking like at that moment. When you start investing in trustees, you're probably going to work through a trustee broker. It's very difficult to get started originating trustees yourself. So make sure that you work with an experienced broker that's got a couple years under their belt, that can demonstrate a successful track record. Absolutely call other investors that use that trustee broker to get a feel for their experience with that trustee broker. And then one of the tips I always talk about is a mortgage pool versus individual trustees. There's really two ways of getting involved in investing in trustees. You can invest your money in a mortgage pool. That pool owns a number of trustees. The advantage to a pool is that your risk is measured amongst all the trustees in that pool. So if one trustee goes bad, that doesn't necessarily mean your entire investment goes bad. The disadvantage, though, is that you don't have direct control over the trustees that mortgage pool is investing in. Yes, they have to invest in a specific scope of trustees that they said that they were going to invest in, but that doesn't necessarily mean that all the trustees that they're investing in are good trustees. As an individual trustee investor, you can select the type of trustees that you want to invest in. You can look at the loan-to-value ratios. You can look at the yields that that trustee is providing. You can look at the specific marketplace that that trustee is located in. And then in addition, you can look at what the borrower qualifications are. So I highly suggest that you take the step, do additional work, and invest directly in an individual trustee. So I want to just use an example of a trustee investment that we made. This was probably about 1.5 years ago. That ended very successfully. So we invested in a property. Our borrower was acquiring a property that was in disarray. They went in and rehabbed the property and put it back on the market and sold it for a profit. In this case, we funded a $218,000 trust deed. That trust deed earned us a 10.5% annual yield. It was secured on a non-owner occupied residential property, so they were just acquiring it as an investment group and going to sell it. The importance of investing or investing in non-owner occupied versus occupied is that a non-owner occupied borrower has a lot less rights than an owner occupant borrower. And I don't really have the time to go into the specifics of this, but typically stick with non-owner occupied real estate. It's a lot easier if you were required to foreclose to obtain ownership or foreclose on that property. The property was located right here in San Diego, California. We lent at what we calculated was a 65% loan to or after repair value. So when that borrower sold that property upon the completion of those renovations, our loan was at 65% of that after repair value. It actually ended up at being at like 50 or 55% of the actual sales price. The property had appreciated that much during the duration of that project. In addition to that $218,000, my borrower funded $75,000 at close of his own cash. So that was his cash equity in that transaction. The term of the loan was 12 months. Borrower had great credit. He had a great track record. And we made that investment available on a $50,000 fractional interest. Something like this, we had probably within 2 to 3 days enough investors to invest in that trust deed. And it ended up being a very successful trust deed. So I always open criteria of the types of trustees that we invest in. We specifically focus on residential. We've done a couple commercial real estate deals, but they don't really come across our desk that often. We fund loans between about $50,000 to about $3 million. Our typical loan-to-value ratios are around 50 to 65. We may go up to 70% depending upon the strength of that asset. Typical yields that we're earning on our trustees about 8 to 12%. We really focus on first trustees. I personally will invest in second trustees on the right deals, but I don't typically make those available to investors unless that investor is specifically sophisticated on second trustees. And the terms of our loans really vary. And this is one of the other advantages of trustees. If you want just a short-term loan, you don't want to take market risk, we've got loans as short as 3 months. If you prefer not to keep rolling your trust deed over to a new trust deed every 3 months, go with a 36-month trust deed. You're going to be earning interest on over a period of 36 months. You may take a little market risk on that asset, but you're not having to roll those funds over. And then we only invest in or fund trust deeds here in the state of California. So last but not least, let's just talk about the advantage of trustees again. As I had mentioned, the number one advantage that I see in trustee investing is that it's a fixed monthly income. Your investment is secured by collateral, so it's secured by a real estate asset that borrower owns. And typically your loan is secured at 50 to 65% loan to value on that asset. There's attractive returns. I compare this to alternative investments. If you leave your money in a savings account that's earning 0.5 to maybe 1/4% per year, you can compare that to the stock market where you see huge changes in annual yields on the stock market. These just offer consistent monthly yields. They offer low to moderate risk. So you can invest in trustees at 50% of the value of that real estate asset. I would consider that a lower risk investment. As you go higher up in the loan to value ratio, 65, 70, 75%, you're moving into more of a moderate risk investment, in addition to the type of collateral that you're using for your trust deed. If you're talking about just a single-family residential home, which is probably the most liquid asset as we discussed, you're taking lower risk. If you are securing your trust deed on land, you're taking larger risk. The ability to fractionalize. So you as an investor don't need $200,000, $300,000 to invest in trustees. With a minimum of $50,000, you can get started in trust deed investments as a fractionalized owner. And then the ability to use a self-directed IRA. So as I had mentioned, Brian Davis with AccuPlan Benefit Services work hand in hand with us to help people establish their self-directed IRA and then invest in trustees. So that really does it for my presentation today. We went over how to get started investing in trustees, what are the basic structures of trustees, what are the yields that you should entertain when investing in trustees, and who you should reach out to about locating trustee investments. Let me just quickly jump over to our website, and I can quickly show you where on our website that we make our trustees available. So if you were to go to our website at talamarfinancial.com, you can go under the Investor tab, and we'll list all the available trustees that we currently have. Now, we currently have 2 available trustees. As you can see, this is one trustee that pays a yield of 10% to the investor net, and it's 65% of its value. It's secured as the type of loan is a fix and flip loan, so the borrower intends to update that property and put it back on the market in a short period of time. The second investment is, again, is a fix and flip loan secured in first position. Term of that loan is 9 months with a fractional interest minimum of $50,000. So we update this daily. In addition, we send out a blast weekly to all our trustee investors about what trustees we currently have available. If a trustee investor liked the trust deed that they see, they can contact us and learn more about that trust deed. One thing I did fail to mention is that you can always click on the summary button here on our website, and I'll provide you a little more detail on that trust deed, including, again, the loan amount, the annual yield, the monthly payments, the type of loan it is, what position it's in. And again, if it's something that you're interested in taking a look at further, you can ask for what we call our executive summary, and that will provide you all the detailed information on that borrower, on that property, and on that investment. So again, thank you very much for listening to our presentation. If you have any questions, again, use that comment section or shoot me an email. My email is bvandenberg@talomarfinancial.com. You can see that there on the screen. Or go visit our website and learn more about investing in trust deeds. So Brian, that about does it for my piece of this seminar. Do you have any other additional information to add?
No, I want to thank you very much for breaking that all down. It was very comprehensive. I'm sure everybody on the call today got a lot out of it. I do have one quick question for you from one of our attendees today. Does Palomar get involved in the foreclosure process?
So yes. So luckily we've not had to foreclose on a property over the last 7 years that we've been investing in trust deeds. But yes, we as a loan servicer, what we call a master servicing agent to that trust deed investor, will go ahead and initiate the foreclosure process on behalf of the investor.
Sounds good. That's the only question I have right now. So if you want to get any last-minute questions, now is the time to do so, either with the question bar or with the comments section. Looks like we got another one coming out. That was just from the attendee, Kathy, who sent that last question, just said thank you.
Okay, I got a question right here, Brian. Someone was asking, how do they get onto the trust deed investor distribution email list? If you want to go to our website, to go under, let's see if I can jump here, just go to our Contact Us page, or page, right here. And simply, if you put in your information here and go to Available Trustees, click on Available Trustees, it'll send me an email with your contact information. I'll go ahead and respond to you that I've received it, and then I've also added you to our trustee blast. As I mentioned, if we get a blast and you don't like a trustee that you may see, don't worry about it. Go ahead and erase it. But if you do see an investment that you may want to consider, just reach out to us. We do make those trustees available on a first-come, first-served basis.
That sounds great. So everybody has Brock's contact info. I provided mine earlier. And I want to thank everybody for taking the time out of the middle of their day on a weekday here to listen to Brock and I talk about investing in trust deeds with your self-directed IRA. Again, we have recorded this, so I should have a recording available for you guys later today. And thank you guys so much. And Brock, we'll look to do it again in the new year.
Absolutely. Thank you, Brian. You take care.
Thank you.